Hello there, and welcome to Marketing Matters, an overview of multi-peril crop insurance, or MPCI. The Federal Crop Insurance Corporation, or FCIC, offers 3 types and 8 levels of taxpayer-subsidized multi-peril crop insurance products sold in 4 different unit types. The unit types are designed to define the nature of the farm area being insured. There are 4 types of insurable units: optional, basic, enterprise, and whole farm. Each of these units have differences in costs per acre and are likely to create variations in indemnities. For example, a highly localized severe hailstorm on a single field covered using basic units would likely have an indemnity versus not likely to have an indemnity for the same storm on the same field when this field is one of 20 other fields covered with enterprise units. It is advisable to talk with your crop insurance agent about which unit type fits the circumstances of the operation for which the insurance is sought. The distance between fields, crop type, location, land tenure, average production history or APH, and other factors each play a role in what unit classification may be best for a particular situation. Unit types affect both cost and risk. Larger unit types make the insurance per acre less expensive than smaller unit types. For example, enterprise units are less expensive per acre than optional or basic units. Generally, however, the larger the area a unit covers, the less likely a loss is expected. This, of course, depends on the triggering event, size, and scope. 4 major units are available: optional and enterprise, as well as basic, in which all acres in the same county are combined, but every crop is separate, as well as whole farm, in which all corn and soybean acres farmed in one county are accumulated. TAPS programming only offers optional units, where each of the 3 plots is covered individually, and enterprise units, where all plots are covered together. For example, a TAPS participant has their 3,000-acre simulated farm. If enterprise units are selected, then the 3,000-acre plot is covered as 1 unit, whereas if optional units are selected, then the farm is insured as 3 individualized 1,000-acre plots. Optional unit means you just insure a single field, and enterprise unit means all your corn is insured together, which is why it is cheaper. There are 3 types of MPCI that will be discussed here: revenue protection, or RP, RP with harvest price exclusion, or RP-HPE, and yield protection, or YP policies. Both RP types of insurance are designed to ensure a specific level of revenue based on the selected coverage rate. RP policies use average December futures contract prices for the spring and February and/or fall, October months and APH yields. Be aware that these averages are based on future contract prices, which do not include an adjustment relative to an operator's local cash market, known as basis. RP insurances may be triggered by a yield loss, a drop in the price, or both. While both types of RP insurance are designed to ensure a specific revenue, RP is the more expensive version and bases its guaranteed revenue on a floating spring or fall price, whichever is highest, whereas RP-HPE is strictly based on the spring price for the revenue guarantee. YP insurance uses similar information as RP, but only insures yield as a % of APH with indemnities based on the spring projected value or price. These MPCI products operate on an annual, automatically renewing cycle and have coverage levels between 50 and 85% of APH in 5% increments. TAPS participants are required to select within this range as well, but at a minimum of 65% coverage. Table 1 shows the subsidy levels of the 4 different unit types, along with the 8 corresponding levels of coverage. It is easy to see that each unit type is subsidized differently at various coverage levels. Using this information and some approximations for insurance quoted for the farm area around the University of Nebraska's West Central Research Extension and Education Center, Table 2 was constructed. This table shows the variation in different premiums with 2 of the 4 available unit types, enterprise and optional units. This table does not reflect any actual premiums, but does represent the differences among premiums by insurance type and level. Each individually insurable farm has unique conditions and location that affect the premiums that would ultimately be paid. The insurance purchaser does not pay the full value of the policy. For example, a farm manager wishes to buy an 85% revenue protection or RP policy as enterprise units. From Table 2, the premium is listed at $37 per acre. The actual cost of the policy, however, is $78.72 per acre, with $41.75 per acre subsidized to the insurer by federal taxpayers. The subsidy rate for the different insurance types remains the same, but the premiums are different. To follow along with TAPS and get involved in this year's exciting new crowdsourcing team opportunity, follow along on Twitter at UNL_TAPS. And for more marketing related content, give FarmSense a follow at FarmSense_UNL. And, of course, you can find our websites at taps.unl.edu and farmsense.unl.edu. Thanks for watching.